In this video, we're going to discuss how you can execute an aggressive wheel strategy using the SDY ETF.
Please subscribe to the channel and happy trading.
The SDY is the S&P 500 aristocrats companies that are associated with the S&P 500. So dividend aristocrat companies are companies that have been around for at least 25 years, have paid a dividend for at least 25 years, and has raised their dividend for at least 25 years. And they are a part of the S&P 500. So you can trade them directly using the SDY here, as you can see. These are associated with dividend aristocrat or aristocrats companies. Okay? So we're going to talk about doing an aggressive wheel strategy on this because this is something that's super safe. You know, people try to benchmark their performance to the S&P 500, and they're usually using something like the SPY. That is the most popular ETF out there. It was the first ETF, and it's the most popular ETF, and that's the SPY. You can see here that the SPY has a dividend about 1.85%, and it pays that out quarterly. If we look at the SDY, which is the dividend aristocrats, a part of the S&P 500, you can see that it's basically a percent more at the 2.95%, and that's paid out quarterly. Then if we kind of look at some performance that the two have against each other, we can go over here to this Google Finance here, and we can take a look. So we're looking at this right here. Year to date, the SDY is down about just under 4%. And if we click over here and look at the SPY, which is just all the S&P 500 companies, that's up a little over 1%. Right? So that's great. If we look at a 1-year chart, and you guys know 2022 was pretty tough, so it was a bear market, and the S&P 500 was down over the last year. It was down almost 20% in 2022, but now that it's into March of 2023, you can see that it was down about 8%. It's down about 8% the last 12 months. Now, if we go over here to the SDY and look at that, you can see that that's actually down a little less, right? Because it has those safe companies in there, those dividend aristocrats inside of this ETF. So if we go back, if we look at the 5-year, you can see that this has been up almost 30%. The dividend aristocrats here been up almost 30%. And if we go over here and look at the SPY, you can see that that's actually been up more, about almost 41%. But you have to still keep in mind that the SDY has paid out a dividend that's bigger, but bull market, which we've been in for the last 5 years, besides the last, it's going to underperform that way. But it's going to do better when things are going down, because people are going to gravitate to those safe havens, those safe companies, those companies that can continue to give a regular dividend, and it's going to potentially give you some appreciation during a bad time, like companies like Coca-Cola, Pepsi, Walmart, 3M, Procter & Gamble, things like that. Those companies are usually going to be some safe haven type of companies, or at least most of those. All right, so what we're going to be looking at here is trading the SDY, but doing it aggressively using the wheel strategy. And we're going to introduce what we call the safeguard strategy at the Dorian Way as well. It's just adding 2 more trading strategies to the wheel strategy. So normally, if you're going to buy some shares, and let's say we were going to buy some shares here at the SDY 10, we were going to buy 100 shares, and we're going to buy it at the mid price that you can see down here. Well, that's going to cost us about $12,000 that you can see here, and that's how much we would lose if the SDY went to zero. It's not going to go to zero, or it's almost a 0% chance that it will go out of business. Nothing's zero, I guess, but this is part of the most safe companies in the U.S. It's going to be a very, very small probability that it goes out of business. But if it did, that's how much you would lose, about $12,000. If you were going to do a naked put to be able to start the wheel strategy, if we sold something aggressive, then we would sell this at the money or a little in the money. So in this case, we're going to sell the at the money, and that's going to, or excuse me, this is the in the money. We're going to sell this in the money here, and it's going to give us about $350 of premium or extrinsic. Okay, that's how much we're going to receive, and that can act as a cushion. So instead of having the max potential loss of 12,000, now our max loss is 11,750. So our cost basis is around 117. So in this area, so it would have to drop below 117.50 before we start losing at expiration. In this case, we're looking at 41 days to expiration. So this is giving us a 63% chance of winning if you sold this naked put, and you're doing it aggressive because you're selling it in the money. This is the in the money area of the put side. And if we were buying the shares outright, and I say we were buying it at this price here, it would basically have a 50-50 shot of it going up, at least initially. Over time, this is going to go up historically. It's going to go up over time, but initially you have a coin flipping chance of winning. But if you do this, if you do the wheel strategy and you start off with the naked put, well, you're going to have a 63% chance of winning within this expiration period. All right, so if you had to take ownership of the shares, let's just say it expired below the 121 and you had to take ownership of the shares, then what you would do then when you're doing a wheel strategy is that you would do the covered call. And normally people are trying to sell covered calls far out of the money. This is the out of the money area and so forth. But you can be aggressive and sell something at the money right here, or a little in the money. So if you want to be super aggressive with it and you sell something in the money, you're going to get about $300 of premium, and that's how much you can make here. As you can see, you can make up to $300 if it expires above 120. Right here, this is the strike, and you can see that it was already trading above 120 at the 120.50. So if it stays above 120 at expiration, you're going to win $300. This is an aggressive kind of covered call type of process. You're betting that it's going to go up, and if it goes up, you're going to win, and that's how much you're going to win. But if it doesn't go up, you're going to help yourself a little bit more, because that $300 that you're receiving in premium is going to offset your losses to the downside by 300 or 3 points. As you can see here, we have the 11,700. So that's the most you can lose if this went to zero. Once again, we indicated it's not going to go to zero, but your cost basis would be around this 117, which would be in here. So it would have to fall below there before you start losing if you executed this covered call process of the wheel strategy. Okay, so you're selling aggressive put that's in the money, and then you are selling a covered call. If you had to take shares, you had to take ownership of the shares, you're selling a covered call that's aggressive because it's in the money, and then it's giving you a little bit more downside protection. But now we want to introduce an aggressive third strategy that we call it. We call it the collar strategy. You can learn about it in the Dorian Way. We got more videos on it and so forth. If you decide to join the Dorian Way, you can learn a significant amount about it. But the collar strategy is basically doing a covered call, and you're taking some of the monies and you're buying a put. Okay, so in this case, we're getting about $300. So if we wanted to buy this put right here, this will turn it into a collar. Okay, to turn it into a collar. So the most you can lose now, instead of if it went to zero, we know it's not going to go to zero, but if it did in the next 41 days, the most you can lose is 335 instead of 11,700. Okay, because you're capping your loss within this time frame. So you can do these kind of trades on something that's 30 days, 35 days, something that's expiring in 7 days, 14 days. We teach all of that kind of concept to be able to enhance your trading, enhance the premium or the dividend that you receive. This gives a dividend, as we indicated here, back on the Thinkorswim platform here. The SDY gives a dividend once every quarter, right? Well, you can do this on dividend aristocrats that have weekly options, and you can sell these type of strategies on weekly options and get yourself a weekly dividend, or every 2-week dividend, or obviously a 30-day dividend, and that could enhance your returns on top of the dividend that you get quarterly from this ETF. So if we jump back over here, this is what is called the collar strategy. We're not really going to go over the basics a lot, but this is a put that you're buying that gives you the right to sell at the 115. So that's going to offset your shares if it goes down. So if it goes down past 115, you can't lose anymore, because this put is offsetting your downside. And then this call here is going to offset the selling of the call is bearish, and so the buying of shares is bullish, so it's going to offset your upside once it hits this 120. But that's okay, you're bullish. This is still a bullish strategy. As you can see right here, this is giving you deltas of 20, so it's still a bullish strategy. You still want it to go up, but if it just goes up a little bit, or in this case it doesn't go up at all, it just doesn't go down, then you're going to win $165 in this case. Okay, you're going to win $165. That's the most you can win. And if it doesn't go down, it's $165. So this is the collar strategy. Now we have one more strategy that we implement at the Dorian Way, what we call the bionic bull. And we call these 4 different strategies the safeguard strategy. You've heard of the wheel strategy. That's why we initiated talking about the wheel strategy. Wheel strategy is usually selling the naked put. If you had to take ownership, you sell the covered call, and then it's just the repeating of that process. Well, at the Dorian Way, we call it the safeguard strategy, because you can sell the naked put, or you can sell the covered call, or you can start off by selling that collar that we just went over, or you can sell what we call the bionic bull, and you can initiate all the trades that way. Once you've already initiated the trades and you already have the shares, then you can only do the covered call or the collar strategy. But in this case, let's say we're initiating. Well, if we're being aggressive, we can sell this put at the 120, and we can buy this call at the 121. So this is going to give us a credit of 25 cents. As you can see, this is a credit on the TastyTrade platform. We got a little over a 50%, a 52% chance of winning. And so someone's paying us 25 cents or $25 to be able to purchase this call here. And so we can have unlimited upside. So if we go over here to this curve view here, this is the at the money line. We are buying a call for free, right? We're getting a call for free because we're selling the naked put. Someone's paying us in premium. We're taking some of that premium and buying this call to be able to have unlimited potential to the upside within the expiration period that we're trading. So this is how you can accelerate your upside. If you think something is going to go up in a decent way, or you think it's going to go up, period, you can benefit more than which if you were selling just a naked put, or if you was just doing a cover call, or if you was doing the collar strategies that we indicated. You can really supercharge your upside with this, what we call the bionic bull. Okay. All right. So these are aggressive strategies that you can implement and that you can learn from the Dorian Way. We encourage you to do that. And we appreciate you watching this video. If you have any questions, please leave it in the comment area. Otherwise, like the video, subscribe to our channel, and we'll see you in the next video. Thanks for watching.